Hi, welcome to Wise Beyond Bitcoin, your home for the crypto neo news, education, and opportunity. My name is Ryan.
My name is Lucas.
And it's been a few days since we've done a macro outlook update on the picture with the war and with monetary policy. There's been a lot of news, so we figure we cover some of it. We touch on these issues periodically. There's been a lot to cover recently, so we've been doing a lot of them. You will find them in the macro outlook playlist. We have other playlists as well, but we're gonna just jump right into this one because there's a lot of meat on the bone, so we better start chewing. Let's start with this handy chart. So what we're looking at is the 10-year Treasury yield. This is the interest yield for holding investing in a Treasury bond. And as you see, there's been a 4-decade or 40-year downtrend that the 10-year has been stuck in, and it's tested it, at various moments. And those are always tend to be, moments of financial crisis, or at least, if anything, sideways movement in prices. The most recent flirtation we had with the upper bound was from the 16 and 17 and 18, 2018, 19 period, when the Fed was attempting to normalize policy after the financial crisis in the 2008-7 period, when QE and all of their accommodation was started, and their balance sheet swole up a lot. And you can see how interest rates took a dive and hit the lower bound in this period and were flat. And, there was a little bit of a rise, but then they were flat, for a long time. And this was a period where policy was going to reverse. We were going to see tightening, right? And much like we are now. So you can see that's what happened. There was interest rates went up, and this was abandoned largely because of the effects of the tariffs and the trade war that we got into with China, and how that crunched the supply chain and created all this systemic risk in the economy. So there was a move back towards accommodation. And of course, when the pandemic started, there was a historic level of accommodation, and interest rates went down with it. So now we're on the other end of that, and we're talking about raising rates and potentially selling off part of the Fed's balance sheet. And we've just started that process, right? We just had a 0.25% rate hike a few weeks ago, the first one. We've been anticipating that for a long time. There was, fear that it could have been 0.5%, but we went with the 0.25%. And so we're on track now for a few of these, and we're already at that upper bound of this long-term trend. So remains to be seen if we break through and create a new trend altogether, or if we just break through and we're rejected, we fall again. That, it remains to be seen. But there's definitely something historic happening in the bond market, and we'll get a little deeper into that later on. But before we do, I found this to be a handy little list of what to expect. This is going to be a news-heavy week we're in now, so we're going to kind of talk about some of the things happening today. The Philadelphia Fed president Harker spoke. We have an article about that. But further, tomorrow, GDP numbers for the U.S. come out. That's going to be very important to see what that looks like. If that number's better, or at least current or at expectation, then that's going to be bullish. And of course, if it's a miss, if the number prints lower than what the consensus expectation is, that's never good. That's always bearish for markets. Later Wednesday, we know another Fed president's going to speak. Thursday, we get some numbers out of China, including the non-manufacturing PMI as well. Later on Thursday, or at the same time on Thursday, OPEC is going to have a big production meeting. This I think is crucial. If we can get an expansion of energy production agreed to, that will ease prices on oil, and that's one of the big things. Energy prices are driving prices and all other things too, because things are transported using gas and diesel. So those prices, when energy is up, you see inflation become an issue across the board. So getting some relief there will be big. We also have another president of the Fed talking on Thursday. And then finally, we end the week with a jobs report. That's another big news item that can and will no doubt move markets, and expectations are the crucial benchmark. We want to see if it can at least meet expectations, if not exceeding them. And if it if it fails to meet expectations and the numbers a little lower or significantly lower than what we expect, then that is another bearish risk, for prices across the board.
So I think this is a good opportunity to go back to our playlist and mention to everyone why we cover this. Because blockchain and crypto, while there are a lot of opportunities, the reality is it's part of a larger ecosystem. It's connected to the world at large. And we look at financial markets, interest rates, supply chain. The health of the economy at large in the world is directly correlated and tied to the growth and the health of this new emerging asset class. And we do have playlists that talk about different aspects of blockchain and crypto and innovations that we like to cover. We'll stick to the macro side of things at the moment. I do want to mention that this is just educational, entertainment information. Nothing is financial advice, commercial,
Yes.
legal advice, or any other kind. So just get that disclaimer out there. and why we're mentioning this is to go to show you how many things can change the price going up or down. There's no anyone to say, oh, this is going to go this way, we're going to go that way. The reality is there are so many major factors, unknowns, black swans, that we know there's some big information to come out, and the effect it's going to have, we will all know together later. So it's just good to be aware of how volatile the market is before becoming involved, at least when it comes to blockchain and crypto. Now, when it comes to the world at large, just as blockchain and crypto is very innovative, well, monetary policy from those who've come from a background in economics, and I will say that what's being done at the Fed and at these levels is also very innovative and
clearly
weird.
Yeah.
So
we're seeing new policy tools being innovated all the time, and they're figuring out as they go, right? They're not and I think that's kind of hinted at here in this article. This is a speech that the president of the Fed from the Philadelphia branch came out, Patrick Harker, today, and said that he favors a methodical series of 0.25 percentage point interest rate hikes. He's penciled in 7 of these, but he goes on to say that he's open to sending a stronger signal with a 50 basis point increase, which would be 0.5%. If inflation is not, if it doesn't get under control, if there's no improvement in inflation. And of course, we have to think about what role, coronavirus restrictions, if they were to be increased, how that might, change things, or of course with the war in Ukraine as well. So there's risks on the horizon that can shift the picture, as you were saying, and so being methodical and being nimble, being open-minded and taking in all the available information, that's the path forward, because there's no clear picture here. This is a very complicated thing. And so, but essentially this is a speech that would reassure markets that they're aware of the risks of slamming on the brakes too fast, going too hard, and with rate hikes too high, or maybe selling off too much of the Fed's balance sheet too quickly, that there's this need to be measured, right, in the approach. And I don't want to get off course, because we have a lot to talk about, but just to give a little historical context to that, there was a period during the Great Depression when the initial collapse had happened, and it was been a few years later. I think it was the initial collapse, it was in 29 rather, and then it took a couple of years, and then in 32, 33, there was a secondary downturn, a secondary crisis period. And looking in the rearview mirror of a series of economists, most notably Milton Friedman and Anna Schwartz, they published their study of this, a big, thick book that most people will never read. I think it's titled The Monetary History of the United States, and it's through a few dates. But essentially what they do is they studied this period in the Great Depression. They try to ask the question, or answer the question, what caused the secondary downturn? And they came up with an answer, and they said it was the Fed's fault. And of course, we're used to blaming the Fed for putting too much money into the economy and blowing financial bubbles and creating inflation. But in this case, the Fed was overly restrictive. They had actually misjudged how tight the supply of money truly was, and they had not taken in as much information as they could have to really get a more accurate picture of the supply of money and versus the demand of money for money. And they ended up undersupplying credit and money to the economy at a crucial period, and essentially slammed on the brakes. And that kicked off this secondary recession, depression that we kind of, which is a large part of what the Great Depression is known for, because it's the length of the Great Depression is what made it so great. And so in many ways, the Fed was guilty of this, of causing that. And so economists now of this generation, the Powells and the Bernanke's and the Yellens of the world, they grew up studying these events, learning this lesson intimately. So whenever they were in a position to do something about a housing crisis in 2007, Bernanke, for example, he knew that that the risk was being too tight with the money. That was the great fear. So that's why you saw helicopter Ben memes, because he was literally printing, large amounts of money, historical numbers, and it was because of this great fear of being too tight. And so this fear still remains, and I believe that's one of the things that's going to limit just exactly how fast and how high these rate hikes go. Nobody wants to be in charge of the Fed in a moment and throw the system into a recession by slamming on the brakes too quickly. So it's a very delicate balance they're trying to strike here.
That's a good, I know this is a bit of an aside, but it brings me back to the future of US policy on blockchain and crypto, and how allowing for a more open, freer, experimentary period market would allow for a sector of the economy to continue to grow and flourish, because blockchain and crypto is receiving support from decentralized worldwide resources, and it would be a way to really bolster a future technology sector, really allow the economy in the United States to grow despite whatever areas there are, constricting, or the high inflation, like you mentioned with oil and gas, which there could be a lot of reasons, supply side as well, to push up on that in the near term, in the future. So it's good to have other areas of growth in the market, and this technology sector seems to be one of the most fruitful.
No doubt. And now this article actually wraps up with a discussion about a topic that I wanted to cover next. So it's a good segue. So recently, the spread between the 10-year and the 2-year Treasury bond has approached zero, which what that means is that there's an inversion happening in the Treasury market where the interest rate, the yield on a 2-year bond is actually higher than on a 10-year. And that is normally in normal times, it's reversed. You're waiting, if you're can tie capital up for 10 years and with all the risks associated with being in that committed for that long, you would expect to earn a higher yield, right? For that, to offset that risk. But in moments where the yield curve inverts, the opposite happens, and the yield on shorter duration bonds goes higher. And so one of this same Fed official that we've been reading, he says he's not concerned about that as being a signal of a coming recession, as it sometimes can be. He says that it's only one signal, and it's not the defining one, and that it's taking into consideration a combination of numbers much broader than just the yield on bonds. That's what he looks at for as an indicator of a recession. So that is something to cool our concerns, because the news that the yield curve just inverted, that's kind of a big deal in financial markets and in financial market news, rather. Now, see, this is it's one of those, sometimes this can be like fear sells, right? And so at times this inversion has been a good signal that there could be a recession in the next year to two, right? That's historically happened, but it often doesn't play out, right? There's been inversions that did not add up to being a recession signal, and we'll leave this article in the description so you can read it yourself. But here is a great quote to get at the point. It says, historically, a recession has not happened without an inversion. But the part that he leaves unsaid is that every recession has historically happened with an inversion, but not every inversion has led to a recession, right? So it's a predictor, but it's not a perfect predictor, right? And it's also very vague. I mean, it could take up to 2 years, right? So, and it's really, it's something to watch, because it is a bit of an irrationality in the bond market. It is a signal that people in the bond market expect there to be potentially higher interest rates in the near future, right? Whether that's through Fed policy or the market adjusting for higher inflation, right? Because that's another driver of this. But I wouldn't take it to be anything that should panic you. And I think I would file this in the same category as the next story.
Yeah, if you're going to be
The death
panicked about
cross.
anything, you should already be panicked.
Right. So here's the next story that goes along with the same in the same theme. So along with the yield curve inverting, we're also getting a death cross in the Dow, the S&P 500, and in the Nasdaq. And what that means is that when you're looking at moving averages, usually you use more than one moving average, and it's the relationship between shorter and longer dated moving averages that are the key technicals. So you're the key indicator. So you're looking for one to cross over or below the other to tell you kind of what the trend is. And a death cross is when the shorter moving average crosses below the longer moving average, which basically means is that the most recent price action is below the long-term trend. And so this is another one of those things. It's called the death cross, so it's got some fear built into it just out of the gate, but it shouldn't be it's not clearly a kiss of death for markets, because historically the stock market at least has performed better after registering a death cross than it did the rest of the time. And that kind of goes to it makes sense intuitively, right? Because if you're going to purchase, if you're getting into an asset at a moment of weakness, when the short term, the most recent price actions is lower than the trend, the long term trend, then it would stand to reason that the next period would outperform, right? Because you're getting it at a discount.
That's when people would like you said, that's when people want to come in and get it at a discount. When they see that,
Yes.
when they see those averages and it appears that the long-term average is going up and where you're at right now is going down, that is a technical indicator for when people will want to come in. So even if it does go down a little bit more, it just continues to appear as a major buying the dip opportunity on a large swing.
Yeah. And I've seen this play out in Bitcoin too. There's been moments where a death cross was announced, and it actually the Bitcoin rallied in the next week or two, and it was like, wow, okay, that was counterintuitive. So it's another thing. It's something to consider. It's something to look at, but I don't think it's something to go out and sell your positions because of, right? But then again, this is not financial advice, so you make up your own plays on that. But just to say that, hey, don't panic. It's just it could be a bottom signal as much as anything else.
It could be a stair step. Well, there are a lot of factors to affect. We'll continue to cover. We've got more covering it right now.
Yeah, we got more to talk about. So recently, the federal government released their budget for the year, and I need to pull up the number on that. I believe it was 5 trillion, or it could have been 6 trillion. I need to look at that. But regardless, I'm pulling up the. Yeah, that's right. It was almost 6 trillion. Mm-hmm. So what I was curious about is, well, okay, we're spending 6 trillion. Well, what's the total revenue, right? Well, how much money does the government have through taxes? How much did it pull in? And it's 3.8 trillion. So the difference is deficit spending, right? That's the difference is going to have to be, bonds will have to be created and sold to finance the gap, right? That's how that works. Whether or not they're monetized through a Fed purchase or not, that's different. That's a different issue. But somebody, public or private, is going to have to buy the deficit to finance, to get this money into the system for that to work. And so I'm bringing this up to say that deficit spending, especially record deficits at $2 trillion or north of $2 trillion in a year, that's a pathway to money and debt and credit creation, right? So these bonds this money will have to be, there will be credit creation and money creation at some point through this, because deficit spending tends to be inflationary. It's adding to aggregate demand. And so I only bring this up to say that in a time when inflation is already out of control, we're upset about, energy prices and home prices are high, and price of used cars and cars are high, and just all the above. We got inflation issues. and the Fed's even, raising rates and about to start selling off assets to constrict the money supply and reduce what they can on their end. You've got the Treasury pumping in through deficit spending, $2+ trillion into the economy next year. So I just say, maybe this isn't the year for that. Maybe there's smarter people at looking at this than I am. So I'm not going to give any advice here, but I'm just saying this looks like a counterproductive move, right? Like we're worried about inflation. Maybe this isn't the time for $2 trillion deficits. Make your own decision up on that.
Right. Counterproductive to try to tighten money supply on one end and then pump a whole bunch of record inflation on the other end. Maybe there should be a little bit more communication on both ends so that they can try and
coordinate.
Coordinate. Yeah.
All right. So what do we have here? We have we're shifting gears to geopolitics, right? So supply chain issues are looming large. I mean, I think if you were looking at what's driving inflation, of course you have to consider the monetary angle, right? The channel that money, the role money plays and how that's impacting prices, right? But obviously we've been pumping money into the economy since 2008, and couldn't budge price inflation at all. Really, it was just flat. Peter Schiff will tell you, to his chagrin, that it didn't work, that they didn't generate the price inflation they wanted to. But when the pandemic happened and the supply chain got hit, all of a sudden we saw price inflation rip, right? And so this what I'm bringing this up is to say is that the sanctions on Russia, because of this Russia-Ukraine war, that's another big hit to the supply chain, right? That's not good for energy prices. It's not good for food prices. And those are the two big things Russia trades in, right? So all in all, very, very much a source of future inflation, no doubt, if we can't deal with that, right? And this is also making it difficult for the Russian economy to export the oil and gas, which is a big part of what they sell, right? And they're being froze out of SWIFT, and they're having their dollar reserves frozen. And they even made the announcement that they were wanting to take rubles, their own national currency, or maybe a national currency of an ally country such as China and Turkey, for their energy, for their oil and gas sales, not wanting to use the dollar and not the euro, right? And beyond that, they're also indicating that they will accept gold. And even more bold of them, they're including Bitcoins in that. If they will, they say they will trade in Bitcoin,
which is timely with other nations declaring that they are going to start using and accepting Bitcoin. So but here's something that's, I think, is kind of funny. Like 2 years ago, no one would have dreamed that you would have politicians. If I would have said President Putin or President Biden or some big name in a country is going to be talking about Bitcoin as a legal tender or Bitcoin as payment for oil. People 2 or 3 years ago, a year ago, would be like laughing, like that is ridiculous. What are you talking about? Even all the talking heads on CNN, MSNBC, Fox, whatever the big channel. So now that we hear about it's becoming common speak about countries accepting Bitcoin or using Bitcoin as a payment for for nations and for debt settlement, or just even talk about it. What's funny is how the price of Bitcoin, even with all of this talk of nations accepting it, and Michael Saylor or Elon Musk and all these huge purchases of Bitcoin, if you would have had news like that in 2017, you would have seen these prices, just skyrocket and shoot up.
No doubt.
Now we hear of Bitcoin being utilized, the world being more accepted, and the price does not at all reflect the growth and of adoption, and as more people are aware of it. And I say this because just as those people who know about traditional financial markets, gold markets, or any other, that there's so much leverage, there's so much manipulation, that why we don't look at technical analysis and prices in the short run is because there's no way to know what the price is going to be based upon the news. But if you look at fundamentals and you look for long-term patterns, then you can potentially see, you have a greater chance of seeing where there is going to be value coming in the future. And I would say that despite the price of Bitcoin being less than it has been at an all-time high, and potentially being able to go down a lot more, I would say that when you look at the adoption and where we are at in the history of blockchain and crypto and Bitcoin, you're still very early. It still appears to be a very great opportunity to learn, pardon me, and
No doubt.
to get involved,
And I think, and it's funny, I think you could read this in multiple ways. You could say, wow, look how Bitcoin and crypto are really, the adoption is underway, and the people are waking up to what the value that they, the digital currencies, and especially, DeFi as well. And, but it's not just digital currencies, but digital currencies that are permissionless and that are separate from any nation state, right? That's the key. So I think that story is definitely in play. There's another story also in play about how fragile and desperate people have to be in Russia right now. So I think both of these stories are being we're seeing the results of both those forces, is what I kind of mean to say here.
You're right, but we're also seeing if U.S. dollars and euros, or if these reserves were being custodial held in custody by certain intermediaries, certain large banks, and now they're frozen and people don't have access to it. Well, now you can see the case for Bitcoin and blockchain and crypto. And the reality is that it's a shame that monetary systems that affect so many people can be so fragile, because when you talk about Russia's frozen out of its reserves, well, when we translate Russia into the billions, the hundreds of millions of people, those that are living, that are in their homes, trying to keep their homes warm. Hey,
many who don't.
Did you go to work today at the factory? No, we're not allowed to work at the factory anymore until, so there's a lot of people that are suffering, worldwide when these things
because
happen.
of the actions of a tiny few, right?
Because of the actions of a tiny few. Absolutely.
Yeah, it is a shame. And I don't, I definitely don't wish any ill will on the Russian people, especially the ones who are neutral or against this,
Or on people in general. On this channel, we don't.
Yeah. We're not issuing ill will on anybody in general, right? Well, maybe a couple, but I'm not going to name them. Keep that in my head.
I don't know their names.
But yeah,
I'm not on the list.
No, you're not. Okay. But that's definitely a cost, or an externality that's, sad, and it's I don't know what the final calculus will be, but there's got to be some price to pay.
Well,
for
the beauty of blockchain
civilians.
In the future is the more decentralized, then you can choose which is frozen out and which is not. And wouldn't it be great if only those people who were acting in certain ways that people felt worthy of sanctioning could be sanctioned, while other people
targeted sanctions?
I mean, that would be, but I'm not. Okay.
But we're not going to wish ill will on anybody.
No, I'm not. But no, not that. I'm saying, when I say targeted sanctions, I'm talking about through a DAO, right? Not some, through a DAO type system, not for a currency.
Well, the cool thing about,
not for a digital currency centralized, give some group the power to,
well, the cool thing about humans is that we all kind of tend to react the same way to profound injustice. And when you see civilians being bombed with military grade rockets, people being wholesale targeted, that, kids, women, and children, that's a few pictures of that would confirm that's happening. I don't think it's hard to get everybody on board to say, hey, people who are responsible for this nightmare, let's turn their wallets off. Everybody would be like, okay, cool. Not a hard hurdle to get, because people don't like seeing that kind of thing. It's one thing, there's scales of, injustice. There's a lot of injustices we're totally cool with just turning a blind eye on.
But don't trade. Have a register.
But if you
want to offer people the opportunity to not trade. So, but
sure.
I could not see a system where wallets can be turned off, because
well, Juno did it more or less, right? With that Prop 16.
I don't believe so. I believe that it was a way of
Oh, it was a
fixing
rolled back and airdrop. Yeah, 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 yeah.
airdrop.
But you know, I'm not saying, I'm not advocating for this. I'm just saying, like, at some level, ostracism's always popped up in human society, and
But
when people
I'm
go
just saying it's good to have it at the
profoundly
foundation level. My point is
right
that it should be at where people can choose. If
individually,
you don't want it at the code of Bitcoin where someone could just go off and arbitrarily turn off a
right?
wall. It can't be that,
No, no, no,
a
not at
good
all.
thing. We don't want that type of power in a monetary system that would be lead to unhealthy results. It appears unharmonious, at
Bad
least.
incentives, yeah.
Yeah, bad incentives for sure. But there, like you said, people would love to ostracize or sanction men and women that do things that are very bad, like things that we
War
unharmonious, to say
crimes
the
and
least,
stuff. Yeah, right.
whatever.
Yeah,
So I think that having systems that allow for ostracization and free choice on who you do and do not exchange with is a natural, organic, healthy way of,
sure.
creating these,
Dealing with it.
dealing with it and creating better incentives. But among
Well,
other things. So yeah, a lot going on in the world, a lot going to happen this week. We will continue to cover a lot. And if you want to be abreast of it, notification bell, subscribe, all that good stuff. I think, did we get, I mean,
yeah, I think we covered it. So
till
thanks
next
for your
time,
time. See you on the next one.
have a beautiful day. Namaste, y'all.